interpretation of financial information. And this step of interpretation would logically follow the steps of preparing financial statements for an accounting period. And once we reach this stage, the financial statements are prepared. We now need to look at what information are they presenting to us and how can we use this information, looking at the past and projecting for the future. So what does this mean? What would we be doing? In interpreting the financial information, we will analyze information on the financial statements. We'll look at the financial statements in detail, look at the figures, and try to assess, did the business make progress this year, or did we not do as well as we expected to do? Remember, when we talk about the period under review, we are talking about the financial year that we are analyzing the information for. In doing this analysis, we'll identify areas of strengths and weaknesses. These strengths are something that we have done well. We know we've done well. We must continue doing that. Weaknesses, where did we go wrong? What did we do that did not contribute or has contributed to us not doing so well? And then we need to take steps to try and rectify that. Remember, while we are interpreting the information, gathering this information, we need to communicate this information. And when we communicate information, we have to bear in mind that everyone who will be interested in this information, they will not have an accounting knowledge. They might not understand the information as they are presented on financial statements. So it's going to be your task to try and transfer this information to them in a logical manner, in an objective way, telling them exactly what in simple terms, what is the financial statements, what are they telling us, and also we need to offer some suggestions and maybe even give advice to management as to how, based on the information that is presented, what can we do in the future. So in a nutshell, that's what we would be doing when we are interpreting and analyzing financial statements. And remember, sometimes in textbooks they might say ratio analysis, or they might say analysis and interpretation, and they are talking about the same thing there. They are saying that, listen, you need to look at the financial statements, see what information is useful for us, and how can we use this information to do better in the long run. Okay, so obviously we need to understand the financial statements if we're going to analyze them. So let's quickly glance at the financial statements that we have covered so far. First of all, we looked at the income statement. The income statement, which is now referred to as the statement of comprehensive income. Okay, this financial statement tells us about how did we do, our financial performance. How did we do this year? Did we make a profit or did we make a loss? So that's what you will see on your income statement. The next financial statement that we look at is the statement of financial position, which you would probably also know it as being the balance sheet. Now, on the balance sheet, you have a list of all your assets, your equity and liability. So this three elements of the financial equation is actually what's communicated on the balance sheet. It tells us about our financial position. It tells us how much of assets do we have, and what's our liability, how much of debts do we have, and what are we actually worth in this business, our equity. Right. The third financial statement is the cash flow statement, or sometimes referred to as a statement of cash flows. And this statement specifically tells us about the money that came into the business, where did we get the cash from, and how did we use this money, the inflows and outflow of cash. Okay, so you have done many examples of these financial statements, and at this stage you know exactly what information you are communicating or what you're supposed to put into an income statement. The information will be different from what you would report in the balance sheet itself, and also in the cash flow statement. Okay, so now having a good understanding of the financial statement, the next thing we need to know is we need to have some idea as to which parties would be interested in the financial statements of this company. Remember, a company being a limited company, especially, it would be listed on the GSC. The public has an interest in it. They have invested the money. So the statements of a public company, they are not confidential. They will be public, and according to the Companies Act, they are bound, they have to disclose that information. So let's just take a few examples from this list to see, rather than just identifying them, let's see why would these people or these parties be interested in the financial statements of a company. So what I would do is I would take four. I have left this list on the slide for some time so that you can get an idea and look at the list. Your task here is to tell me why you think that these parties would be interested in the financial statements of the company. I will take three of the most obvious ones, and then you would do the others in your exercise books. So first one I want to take is the shareholders of this company. Why would the shareholders be interested in the financial statements? Quite obvious, isn't it? They are the owners of this company, owners because they have contributed to the share capital of the company. They bought shares, they have invested their money, and they want to know if they have made a good decision by investing in this company, and is their investment in the company beneficial to them and to the company in the long run. So they have an interest in looking at the financial statements. Okay, the next example I want to take is SARS. SARS, SARS, they are interested in the tax of the company. They want to know whether the company has calculated their profits correctly and they have applied the correct percentage, a formula in determining the amount of tax that they need to pay. Remember, a public company would have to pay income tax based on the income, on the net profit that they made. Right, so SARS has an interest there to see if everything is in order. Okay, and also SARS would, while they are doing that, they would check to see if the company is also registered for VAT, because VAT is also another form of tax that the company needs to pay. Let's take one more example. Right, the trade unions and the employees. Why would they be interested in the financial statements? Remember, trade unions are bodies that represent the employees. Employees belong to a trade union, and the trade union looks after their interests in the sense that to see if they have good conditions of service, that they are getting good increases, they're entitled to all the benefits, they have holidays, they have leave, etc. So if they are having any issues with management and employee, they have a union that would support them in taking their complaints forward. So they are interested to look at the financial statements as well, because they work there, they earn a living there, they expect to get an increase each year, and they want to know if my prospects of a long-term employment in this company is guaranteed, or should I start looking elsewhere for a job if this company is showing that it's on the downslide. Okay, so those are the three examples that I wanted to take. And I'm hoping that you would go and discuss why do you think that the other parties that I listed here would be interested in the financial statements of the company. And not only that, maybe you can even put other boxes in here and see if there are other parties which I have not put on this list that might also be interested in the financial statements of a company. Remember some important words that might come up here. For example, prospective shareholders. If I say prospective, it means that they are not yet shareholders, but they are looking at the performance of this company. They probably look at the marketplace and they look at the newspapers and they want to see how this company is performing, and they will probably like to buy shares. So prospective shareholders are people that would like to buy shares in this company. And then the other important terms that you need to clarify, you have an internal auditor and you have an external auditor. Remember, these are two different parties, although it's in the same box here. Financial statements, let's look at what do they want to know. We know who they are. What do they want to know? So, in communicating to them, we will look at financial indicators. Now, financial indicators is a long section. It has a number of different categories, and each categories would have a number of different indicators. When we use the word indicator, indicator is something that tells us about something. So let's look at the categories of financial indicators that we are familiar with. Remember, some of these you were introduced to them from grade 10. So I would be refreshing your memory now when you look at some of these different categories of financial indicators. Right. So the first one we want to touch on is solvency. Solvency is the name of the category. Let's refer to this as a category of financial indicators. Remember, each category of financial indicators, the nice, easy way for you to remember them is to always associate them with a type of question that they would be answering. So when I talk about solvency, in my mind, I must be thinking, what question will this category of financial indicators be addressing? Right? So I did put in a question for each one of them here. With regards to solvency, the question that comes to mind here, will the business be able to settle all its debts using the existing assets? So clearly looking at that question, the emphasis is on the word all its debts, and all its debts to me is going to refer to the total liabilities of the business. Remember, total liabilities would include the non-current liabilities plus the current liabilities. That would give me my total liabilities. And Solvency wants to know is, will I be able to settle all my liabilities using my existing assets? Existing assets, my total assets. Again, yeah, my total assets. I'm not looking at just one thing. I'm looking at my non-current assets plus my current assets. So that basically what solvency is addressing. It wants to see if this company has more assets than liabilities. Remember, if the liabilities are greater than the assets, then this company is in danger. That means they are not owned by the business itself, it's not owned by the shareholders, but it's more owned by the the people that have granted it credit, like the banks, and you probably come across the term bankruptcy or liquidation. And that would be a situation that would come to mind here when my total liabilities are more than my total assets. And when I calculate this financial indicator, I will look for my total assets. I will get this figure from my balance sheet, like I pointed out here. Where do we get the information? It's in my balance sheet. I would look at my total liabilities, and I would express them as a ratio. Something is to 1. X is to 1. So my total assets, my figure, I will divide that by my total liabilities. I will get a ratio X is to 1. It could be 2,5 is to 1, 6 is to 1, 0,7 is to 1. So whatever the figure is, I'm going to make something is to 1, expressed as a ratio. So that would be called my solvency ratio. Okay, so that's the one category of financial indicators. The next category of financial indicators is liquidity. The question that liquidity would be asking when we look at this category, will the business be able to settle its short-term or current debts in the short term, that is within 1 year? In other words, can this company pay off its short-term debts using its short-term assets? Simply put, short-term debts now would focus only on the current liabilities. You see, solvency was talking about the total liabilities. Liquidity would speak about the current liabilities. And can I pay off my short-term debts, current liabilities, using my short-term assets? I won't look at total assets. I would look at only my current assets. So in this category of financial indicators, we have 6 financial indicators that we study under this category here. The first one, the current ratio. The current ratio again, any ratio will show them x is to 1. So the current ratio talks about current assets is to current liabilities. The second one is my asset test ratio. Asset test ratio is where I take my current ratio, I take current assets, and I minus stock. I want to know what would I be able to pay my short-term debts if I did not take into account stock, or another word for stock would be inventories. And then I will look at that as a ratio, as a figure comparing it to my current liabilities. So this two you would always analyze together, the current ratio and the asset test ratio. Remember, the current ratio would tell me about my total current assets is to current liabilities, whereas my asset test ratio would look at my current asset minus the stock is to current liability. Okay, so where do I get the information for this tool? I would be looking at my balance sheet. I know on my balance sheet I have current assets in the asset section, and then I also have current liabilities under the equities and liabilities section. So I don't need to look any further than my balance sheet. The next two financial indicators reading together would be my stock turnover rate. That stock turnover rate is a financial indicator that will tell me how many times in the year I am replacing stock. In other words, how fast is my stock moving? So the answer here would be a number of times in the year. If I say 5 times in the year, and I know the year has 12 months, that means it's just more than 2 months. Every 2 months I am replacing stock, because that's how slowly the stock is moving. So clearly, the stock turnover rate, I would like to see a bigger figure over here. I'd like to see a figure like 10, 11, 12. Remember, if my answer here is 12 times, that means it's once a month. Anything less than 12 is obviously going more than a month. So tied up to the stock turnover rate is your stock holding period. The stock holding period, it tells me how many days is uh, uh, the stock staying on my shelves. So I'm using days here. I can also use months. So I want to know how long is the stock staying on my shelves. Remember, the two are linked, like I said, because if my stock turnover rate is 12, that means once a month. And if I want to look at the days, how many days, then I should be getting an answer here of around 30 days. 30 days stock is staying on the shelves. Sometimes the days is a better indicator, because I know it gives me a clearer idea of how long the stock is staying on the shelf. Stock holding tell me how long. So what do I use to calculate these financial indicators? I need to look at the balance sheet, because my stock figure will be there on the balance sheet. Remember that it is a current asset, so therefore I'm looking at the current asset section. And then my formula needs me to look at the cost of sales. The cost of sales will also be part of this formula to calculate stock turnover rate and the stock holding period. And the cost of sales is something that I will get on my income statement. I don't be too concerned that I'm going a bit too fast with the actual financial indicators. At this point, it's quite important for you to remember the names and the category that they belong to. Remember, this year you would be given a formula sheet, so you need to tie up the names of the financial indicator against the formula that is given on the formula sheet. So you will know exactly which elements from the financial statements are used to calculate that specific financial indicator. Like I just said now, the stock turnover rate and the stock holding period, they will be using the trading stock amount, and they will be using the cost of sales amount which you get from the income statement. Right, the next two financial indicators that I want to look at is my average debtors collection period. In other words, how long does it take debtors on average to settle their accounts? So when I do this calculation here, I want to get an answer which is explicit, taking to settle their accounts. Remember, I grant them credit, which means I allow them to buy the goods on credit. They are not going to pay me now, but I expect them to pay on a regular basis because I am going to need the cash to pay to make other cash commitments of the business. Okay, linked to that would be my average creditor's payment period. How long does it take me to settle my accounts with creditors? Remember, I'm talking about liquidity here, short term. So this 2 year would be linked in a sense that debtors are people that I allow to buy on credit. They are not going to pay me now. They're going to take the goods. Whereas creditors are people that allowed me to buy goods on credit. I am not going to pay them now. I'm going to wait for the statements to come from them, and I'm going to pay them on hopefully on a regular basis. Okay. Now the days that I take to collect money from debtors or to settle my debts, obviously this would depend on my credit terms. So credit terms with debtors normally it's 30 days. So I would compare it with the 30 days to see if they are paying on average within 30 days. If I'm getting an answer of 30 days, then I'll be fine. I won't be too concerned. But if the days are going much longer, that means debtors are not paying their accounts on time, and then I need to take some action against that. Likewise, with my creditors, I've also have credit terms that they have granted me. Some of them would grant me 30 days, some would grant me 60 days, 90 days. So I would see whether I am trying to comply with the payment credit terms that they have offered me. So to calculate these financial indicators, I would need to look at my balance sheet. My balance sheet would give me my balances for debtors, trade and other receivables, and my creditors, trade and other payables. So I know that information would come from my balance sheet. And then from my income statement, I need to look at sales and cost of sales. But the income statement itself is not very clear here on what portion of the sales is credit sales. I need credit sales, and also I need to know about credit purchases. So when you come to this 2 year, and if you are required to calculate them, just look carefully for the additional information that is bound to tell you the percentage of total sales that is makes up credit sales, or the percentage of the cost of sales that accounts for credit purchases. Okay, so that would be your liquidity financial indicators. The next category that I want to look at is called profitability, and sometimes it's referred to as operating efficiencies. The preferred term here is profitabilities, and let's look at the questions that this category of financial indicators would be addressing. First of all, the questions: how did the business perform this year? Performance, you know, its income statements. How did we do this year? Did we make a profit or did we make a loss? And was it better than last year or worse than last year? So we bring a small type of comparison as well. And then we look at expenses. How did we control expenses? Did we control it towards expenses, operating expenses, compare 1 year to the next? Did we do better or did we do worse in the manner in which we controlled our expenses? Remember, controlling expenses is going to obviously impact on the performance, overall performance of that is your profit or your loss. Okay, so just put in a few of the financial indicators here. You've got, remember, they are all expressed as a percentage. So you're looking at a percentage of the net profit on sales, percentage of the gross profit on sales, percentage of the operating income on sales. Okay, so anything that you have to express as a percentage, you're going to say times 100. So you'll have, what's nice about this category of financial indicators, you don't need to really look at carefully studying your formula. You need to just look at the name of the financial indicator. It would give you an idea of what figures you are going to use. Let's take one. Let's take operating profit on sales, percentage operating profit on sales. So clearly, operating profit is an amount on the income statement. You find that amount and you divide it by sales times 100 over 1. You would get your percentage operating profit on sales. So the name of the financial indicator here is telling you exactly what figures you need to use. Okay, net profit on sales, net profit divided by sales times 100 over 1, you get a percentage. There's only one problem that I could see with this net profit here, because sometimes you need to look at, I want net profit in the point of view of the company. Is it net profit before tax or net profit after tax? So they would be quite specific on that point. Net profit after tax on sales or net profit before tax on sales. So you don't need to worry too much about this category. You just look at the name of the financial indicator. It tells you exactly which figures you need to use. You multiply by 100. All the information you need to calculate this is straight out of your income statement, and it tells us how did we do this year, and you need to also compare. It's important that we compare. Okay, so moving on to the next category, your return on investment. Return on investment, this category, the question that is asked here, what is the benefit or cost being the opposite of benefit, to the business or the shareholders in terms of their investment made? Simply put, how did my investment in the business do this year? Did I do well, or did I not do that well? Or did I make a wise decision in investing my money in this business? So return on investment, I would look at first of all the return on equity. And sometimes you won't see this being expanded to say return on shareholders equity, ROSHE, return on shareholders equity, percentage return. So clearly I'm going to look for my formula here. It's going to take my net profit after tax and divided by the average shareholders equity. I'm going to get my answer, which is going to be in the form of a percentage. That percentage is important. I need to know whether it is a good percentage or a bad percentage. Obviously, I'm going to need to compare it against something. And then, as an individual shareholder, I need to look at the dividends per share. Dividends is the portion of the net profit that is distributed to shareholders. Okay, it's a portion from the net profit. The company, after they have paid the taxes, they might decide how much they want to retain in the business and how much do they want to give the shareholders in the form of dividends. So DPS is always per share. You'll get an answer of 22 cents or 18 cents. And again, I need to compare this against what was given to me in previous years. So dividends per share is close to an individual shareholder's interest. Earnings per share. How did the business do this year per share? Remember, my earnings now is my net profit for the year. Net profit after tax, that will be the total amount. If I divide that by the number of shares, I will get my earnings per share. This tells me how much each share has earned in terms of the net profit. And these two are normally analyzed together. They analyze together because, like I said earlier, your dividends is the portion of the net profit that is distributed to the shareholders. Now, using this DPS and EPS, there is an additional financial indicator which is called my dividend payout rate. Now, you will come across the dividend payout rate being tested quite often in the last few examination papers. To calculate the dividend payout rate, you take your dividends per share and you divide by your earnings per share times 100 over 1, and it will give you the percentage of the dividends, the percentage of the earnings per share that is distributed as dividends. To make a simple example, if the earnings per share was 90 cents and the dividends per share is 45 cents, so 45 divided by 90, that would be 50%. So the dividend payout rate would be 50%, which means that the company paid out 50% of the earnings in the form of dividends. So just keep that in mind when you are analyzing dividends per share. You won't do that independently. You would always look at dividends per share together with the earnings per share. And remember that the part of the earnings which you did not give the shareholders as dividends, that would be a part of the net profit that is retained by the business. It would go into the retained income account. Okay. Return on capital employed. I just wanted to point out here that this really does not belong to the category of return on investment, because as the term here, capital employed, it's not only the investment in the business by the shareholders, it would also include the non-current liabilities of the loans. So when you look at it, come across the term capital employed, remember capital employed, the amount of capital used in the business, it's your own capital, that is your shareholders' equity, plus your non-current liabilities, your borrowed capital. So just bear that in mind. We don't want to discuss it too much under the return on investment, but although it is a return, percentage return. Okay, so looking at the information, where do I get that from? I need information from my balance sheet. That will be my shareholders' equity. And then I also need to look at my income statement. I'm going to need my net profit before tax, my net profit after tax, my earnings, which is net profit after tax. Dividends I would not get on my income statement. I would need to look at the notes to the balance sheet that will tell me my dividends, which note specifically is your retained income note. That's what they have. Your interim dividends and your final dividends. So your total dividends, you would get them from your notes. And then when you're looking at any financial indicator that requires per share, that means you need to know the number of shares. The balance sheet itself will not give you the number of shares. There again, you need to look at a note, your note for ordinary share capital. It will give you the number of shares which you're going to use in the calculation of these two financial indicators. You will notice here what the interest rate on fixed deposit. As you will always link the interest to fixed deposit to the percentage return on shareholders' equity. You'll compare these two, and whenever you come across exam papers that talk about an alternative investment, remember they are saying that this shareholder, he bought shares in the company, which means he invested his money, took a decision to invest his money in this company because he expects a certain return on his investment. And remember, he had a choice of also putting this money into a fixed deposit. And remember, banks would give him an interest on his fixed deposit, normally at a fixed rate, and there is quite sure of what he's going to get. It can change, it changes minimally, but it's quite certain. This is more of a certain investment. It will not take much of a chance, but when he buys shares in a company, he takes a greater risk because he's not really sure of the profitability. Obviously, he'll be looking at trends to try and gauge whether his investment is good or the degree of his risk is high or low. So just bear that in mind. For return on investment, focus mainly on ROSHE, return on shareholders' equity, the DPS, the EPS, and this 2-year linked to your retained income to get your dividend payout rate. Right. Now, the next category of financial indicators would speak about the risk and gearing. Risk and gearing is always focusing on the loan of a company. So whenever you see any exam question that wants you to interpret the loan itself, does the company make a good decision taking out a loan or repaying the loan? The word loan is going to make it easier for you because you know exactly what you need to use to answer that question. So let's break it up into smaller parts and look at the question first of all. The question says, to what extent is this business making use of borrowed funds? In other words, what is the proportion of borrowed capital to own capital? So your borrowed capital, that would be your non-current liabilities, and your equity, this would be your shareholders' equity. So you do a ratio, something is to 1 again. You're getting quite used to this now. X is to 1. You will show the extent of the debt in terms of your equity. When calculating this financial indicator, remember you want a financial indicator where X is always less than 1. When X is less than 1, it means that your equity is greater than your debt. The company is not at risk. So your answers, now let's just analyze 2 examples. If I get an answer of 0,2 is to 1, that means I am not making extensive use of loans. 0,2 is a small percentage of the capital that I'm using in the business is made up of the loans itself. and we refer to that as being low risk. Low risk is when you get an answer like that, 0,2, 0,1, 0,4. Once your answer here tends towards closer to 1, 0,6, 0,7, 0,8, then we refer to that as the company tending towards higher risk. Higher risk meaning that the company is making more extensive use of loans in the company. And then once we have decided that, we will use the word high risk there, tending towards higher risk, and then we will analyze further to see whether in using those loans, are we actually making a good return or not. So this on its own would just simply tell us the extent of borrowed capital to own capital. Then we need to go further to analyze, is that loan working for the business or is it not? To get an answer to that question, I'm going to look at my percentage return on capital employed. Taking my capital employed, remember this is my capital employed now. Non-current liability plus shareholders' equity is the capital employed. By using that capital employed, what is my percentage return? That percentage I normally compare it to the interest rate on the loan. So interest rate on loan is the expense of borrowing. Just always think of the interest that you pay is your expense of borrowing. Those economics learners, you know, when the bank charges a high interest on loans, they are discouraging people from borrowing. So when the interest rates are high, they discourage you from borrowing. That means they are saying, no, listen, it's going to be very costly to borrow. Be sure that you need the money before you borrow. And once interest rates start dropping and it's more affordable, then people will start borrowing money because they can't pay the interest back. So that is why the interest rate on the loan is always compared to the return, the percentage return on the total capital employed in this business. The terms that you must become familiar or you're already familiar with here is the terms positive gearing and negative gearing. Bear that in mind. Now to break that down further, positive gearing is when my return on capital employed is greater than the interest rate on loans. Okay, to just put it into a more practical example, if I am paying interest at 12% per annum, but I managed to get a return on capital employed of 17%. So the 17% being greater than the interest rate on the loan, that's an indication of positive gearing. Positive gearing, it means I have made effective use of the loan. I use the loan in a constructive way to increase my profitability in the business. I am now able to pay the interest and to show a positive balance on my profitability. Now, on the converse of that, if my percentage return is 9% and the interest on the loan is 12%, that would be an example of negative gearing, an example where the loan is too expensive. My return by using the loan with my own capital is not even covering the cost of this expense, and that's where you get the term negative gearing. Just bear that in mind as we come to other questions later on. You will know how to use them in answering questions on risk and gearing. So this category on risk and gearing, there's only three things that you need to focus on here: the debt equity ratio, the percentage return on capital employed, and the interest rate on loan. This figure here you do not calculate. It's a figure that is not been given in the exam paper, and I sometimes like to textbooks referred to as market prospects. This category would answer questions like, what is the value of my shares in terms of the business records and on the open market? So that question is quite a nice question. You need two things to look at here. What is the value of my shares in terms of the business? The business records will be against the balance sheet, and on the open market, we're talking here about the stock exchange. So when you see a question like this, remember those two important points. The business records being the balance sheet of the company, and the open market being the stock exchange. And sometimes you'll see they will say Securities Exchange, or they will say the JSE, the Johannesburg Stock Exchange. Remember, they are talking there about the open market where the shares are bought and sold. Another question, are the new shares being offered at a fair price? Remember, sometimes the company would issue new shares during the year, additional shares, and they will give you in the exam paper, they'll say new shares are issued at, and they give you a price per share, which is like 730 or 1040, whatever the amount might be. And questions are normally based on that, asking you to assess whether the new shares were offered at a fair price. And that fair price is going to be a comparison between the value of the shares according to the business records and the value of the shares on the stock exchange itself. Another question, does a company pay a fair price when shares are bought back? Now, sometimes a company is buying back shares from shareholders. They normally, in an exam paper, use the term disgruntled, or a shareholder that died, buying from his estate, or someone who's unhappy about being a shareholder in his company. He wants to sell his shares back to the company. So the company buys back the shares and they offer him a certain price per share. So then again, we want to know, did we give this person a fair price? And again, we're going to compare that against the business records and against the open market. You see, I'm emphasizing those two. So the two important financial indicators here would be your net asset value. If your net asset value is per share, so we should write the word per share here. NAV, net asset value per share, we're looking at the number of cents. Remember, the net asset value is talking about the value of the shares according to the business records. So to calculate the net asset value, I will take my shareholders' equity divided by the number of shares times 100/1, and my answer there would be the number of cents. The market price of shares, this one here I can't calculate, that's why we've got an asterisk here. This is the value of my shares on the stock exchange. So I need to look at that all the time to see how are the shares in my company performing on the stock exchange. And this market price of shares is determined by the supply of shares and the demand of shares in the stock exchange. At this point, you need to note that the stock exchange is a market that deals in selling shares. And again, I like to make reference to my economics learners. They know what a market is, and a market is a place where anything is sold, and a market, whatever is being sold in a market, is going to be influenced by the supply of the product being sold and the demand for that product. Okay, so now the market price of the shares, if my market price of the shares are high, that means people are interested in the shares in my company. My company is popular. People want to buy shares. There's a demand for my shares, so the market price would be high. And if the market price is low, then obviously the opposite would apply. It means something went wrong in this company. There's probably some bad publicity, or they look at the trends of the profitability of this business and they notice it's not too good, and people are not really keen or interested to buy shares in this company. So the market price of the shares in this case here is low. Okay, so these two here they are compared together. You need to look at what is the value of my shares according to the business records, and also what is the value of my shares on the stock exchange. So just note now that these two you look together. Where do I get the information? It would be on my balance sheet to get my shareholders' equity, and then I need to look at the notes to look for the number of shares. Right, so I've got a break here just to point out there's some other definitions that you need to know, and they all relate to share prices. When I talk about the issue price is making reference to new shares being issued, and at what price am I issuing that? That would be termed as my issue price, and sometimes you will come across the term buyback price. They are talking about the price that I have given to those shareholders from whom I bought back those shares. And you'll also come across the term the average share price. You are quite familiar with this when you've done the note for ordinary share capital. The average share price at any point in time is taking your ordinary share capital and dividing by the number of shares, issued shares at that moment in time. Okay, so that would cover now the different categories of financial indicators. I hope you're quite familiar with them. You don't need to stress too much about the formulas. Remember that I told you earlier on you would be given a formula sheet in the examination. Look for that on your question paper. It would be normally stapled to your question paper. But as a word of advice, you need to get a copy of that formula sheet now, because on that formula sheet, you would not be given the names of the formulas. It would not tell you debt equity ratio. It would not say net asset value. There'll just be a formula written there. It would say shareholders' equity divided by number of shares. Now, if you don't know the name of the financial indicator, sometimes it might not be useful for you to have the formula sheet. So while you have some time, what you need to do is look at that formula sheet, and next to each formula on that formula sheet, write the name of the financial indicator that each formula there is referring to. Okay, so that would cover the financial indicators. Now, going into a little bit more in depth on the interpretation and the analysis. Okay, when we look at company financial statements, you might come across a situation where they'll say the company has made a net profit of 2.5 million. So you have a figure here, a net profit. The company made a net profit, and a figure is given to you. And then you need to think now: is this good or is this bad? Remember, if this is the only information you are given, like our friend here who's got a question mark on his head, he would not be able to determine if this is good or bad, because just simply looking at this information alone, it's insufficient information. I don't know what's the nature of this company, what are they selling, what's the product, how big is this company, how do I compare this to previous years. I need a little more information to make an assessment on whether this net profit of 2.5 million, is it good or is it bad. So this brings me to the actual interpretation that I need to do. There has to be some form of comparison. I can look at figures. I can look at the figures from one year to the next. I can look at percentages. I can look at ratios. You have seen this. I've shown you in an extensive discussion on the different categories of financial indicators. So now, when you are doing the comparisons, what are we comparing? So this is what you need to bear in mind. When you do your comparison, you are looking at information of the same business. So in the same business, you'll be looking at 1 year to the next year. From 1 year, last year, how did we do compared to last year, compared to 2 years back? Some businesses, they normally like to do comparisons over a 5-year period, where they get a better idea of a trend. So the same business, you compare the same business. The next aspect that you can compare to a predetermined target. If you set a target, you compare your performance against that target. A common example here would be a markup percentage. So markup percentage, remember, the firm determines the markup percentage. I might decide I would look at a situation like a target, like how much of sales did I want to make? Did I achieve that level? What was my did I manage to achieve the markup percentage that I set, and why didn't I not achieve it? So that's what I do when I look at a predetermined target. Alternative action is if I could have done something else instead of what I've done here. For example, if I invested money in this business instead of a fixed deposit, that's an alternative action. Or I borrowed money, it did not work, I increased the non-current liabilities. Should I have issued more shares in place of borrowing? So that's where you get a case of alternative action. Sometimes I would make comparisons in the same industry. This is an important point because if I am going to compare my performance against another company's performance, sometimes we would use the term here competitors, looking at competitors. It is important that I compare against firms in the same industry. Uh, Most of the time, it's difficult to make these comparisons because companies run differently, they use different policies. You cannot compare things that are unlike. So, in trying to look at same companies, you try to look at companies that are run on very close uh, patterns to your company, selling the same product, using similar policies for stock, for depreciation, etc. And you can make some meaningful comparison with those companies to see what are they doing. Either they are doing better than you, or how can you use some of their ideas to improve on the performance of your business. So you would get examples in an exam paper where information of two companies are given to you, and you'll be clear, they will clearly tell you that the companies operate in the same industries because we expect you to actually make a comparison between those companies to say which one is doing better. And you can only do that if you are comparing things that are almost like terms. Okay, now knowing that much about how you should go about making those comparisons, let's look at a strategy for answering interpretive questions. This is the crux of exam type questions. What do we do when we see these questions in the exam? We need to have some strategy. How do we approach this and how do we structure our answer? For me, it is most useful to stick to this 3 point strategy. You can't go wrong. So you read the question. The first thing you need to do is you need to quote the relevant financial indicators. Just give the name the required number. Um, just naming the financial indicators, that would be your first step. So if you are required to comment on the liquidity, name the financial indicators that are given to you. For example, current ratio, asset test ratio, your stock turnover rate. You need to know the relevant financial indicators that belong to that category. So quoting the name itself. The second step, quote the figures and show the trend. So this is the most important step. After you've written down your financial indicator, always quote the figures. Always quote the figures and always show the trend. Sometimes a figure on its own is not going to tell me much, like I showed you here. If I give you one figure, it's not going to tell me. I need to see a trend. That means either it increased from one year to the next, or it decreased, an increase or a decrease. And the third part, which is the most critical part, you need to comment on those figures. The comment, you showed me the trend, you first gave me the financial indicator, the name. So now I know that you understand this question, you know what to use to answer this question. And then you gave me the figures, you showed me whether it increased or decreased from one year to the next. You said that the debt equity ratio, it increased from 0.2:1 to 0.7:1. So you showed me the trend, you gave me the trend, and now you need to tell me whether that increase or decrease, was it good or whether it is bad. This comment is what will tell the examiner or the person marking your work whether you really and truly understand what those figures are telling you, the information conveyed by those figures. So now, let's look at this example of the debt equity that I mentioned here. I said it increased from 0.2:1 to 0.7:1. Now remember earlier on, I said 0.2 is low gearing. That means we are not making that much use of borrowed capital. We are making more extensive use of own capital. But if it moved to 0.7:1, that means now all of a sudden we have increased the loans. We have taken much more loans, and we have put the company into a situation where it is at high risk. Now, we need to assess whether that was good or bad, and we can't do it by just looking at the one financial indicator. We need to look at other financial indicators together with that to see whether that increase was actually good or whether it was bad. So you just remember this three steps. Step number one, name the financial indicators. That's 2 marks. Step number two, quote the figures. Did it increase or decrease? Step number three, comment on the increase or decrease. Tell me whether it was a good thing for the company or is it a bad thing for the company. Right, so that's what you are going to do when you go into deeper analysis, answering these type of questions in the exam. Okay, before we look at a practical example, let me give you some important considerations, things that you must bear in mind when you are approaching questions in a test or an exam. The first important point, always quote the figures or evidence and the trend. That's critical. You must quote figures and you must show the trend. Like I said, one figure on its own is meaningless, and only use the financial indicators that are provided in the question paper. You'll understand what I mean by this point here when I show you the next slide. Only use the financial indicators provided in the question paper. Okay, bullet number 2, consider the nature of the business before arriving at a conclusion. So don't just say that this is good for the business or this is bad for the business without having some idea of what this business is selling, what is the nature of this business, what do they do. Okay, because what they do is going to influence whether a financial indicator is good or whether it is bad. The third bullet, use related financial indicators to provide more meaningful responses. So this point here is simply saying, do not use one financial indicator on its own. It will not tell us much. You need to make reference to more than one financial indicator when you are answering a question. The next bullet, provide additional calculations if necessary to enhance the quality of your response. Sometimes you might need to make a point by bringing in some additional information to answer a question, and that you might need to do an additional calculation which is not given in the table of information, but you need to do that on your own. Do that and provide that information if it's going to make your answer more complete. This is what we mean when we say enhance the quality of your response. It's giving more meat to your answer. And lastly, try to identify the predictability of the question and be guided by the vocabulary used in past exam papers. So this here is just an exam technique. It is saying that when you come across these questions, always think of some of the way the similar question was answered in previous exam papers, and look at the predictable nature of the question. Don't try to be too fancy with your answers. They must be very short, to the point, and very clear. Sometimes you might even need to just give an example, and that might be enough to give a meaningful answer to the question. For this point here, I always have nice class discussion with my learners, and some of them might come up with some very creative answers. And I always tell them it's good to have these creative discussions in class, but when you're answering them in an exam, always financial indicators. Unfortunately for you, they're not going to be in this format here with the nice colors, etc. in an exam paper. You will see the familiar style. It's got the year 2019. This would be last year's figures, and 2020. This would be the current year's figures. So these are a list of financial indicators that they gave you in an exam paper. Now, previously in my points to consider, I mentioned that you must only use indicators that are given to you in an exam paper. So when you need to answer any questions based on this table, you can only take the financial indicators that they have presented to you in this table here. So let's just look at them quickly. You can even do this in your exam. You can take your highlighters, highlight the ones that you know that fall into the same category. Okay, what I've done here is put them close by so they are linked. Sometimes they're not linked, they're a little more tricky. You need to assess exactly which ones belong to which category. So what did I do here? I've got current ratio, asset test ratio, the rate of stock turnover, or sometimes stock turnover rate, and the average debtors collection period. So I've given you 4 financial indicators from the one category. Those 4 belong to the liquidity, the category called liquidity, and we've done them already, so you know now. From our list earlier, there were 6, but in this exam paper they've given us 4. So this is what I mean when I said use the financial indicators that are provided to answer the question. So you can only use this 4 to answer the question on liquidity. Looking at the next 3, return on shareholders' equity, earnings per share, dividends per share, these 3 are talking about return on investment. So these are my return financial indicators, right? I know these 3. Then I've got my gross profit, operating expenses. Just by looking at the word sales, I know these are all percentages. They are talking about profitability. And I've got return on total capital employed, I've got debt equity, and I've got interest rate on the long-term loan. I know this will be talking about risk and gearing. And then I've got my net asset value and my market price of shares that are given to me here. That will be talking about share prices. So it is something you can do very quickly in an exam when you see the table like this. You can quickly sort out to determine which categories of financial indicators that they have given you, and then uh, how are you going to use them to answer these questions. Remember sometimes that there would be question marks in between here in this column, and if you see a question mark there, that means those are the ones that you would be required to calculate in this exam. So my advice once again, if you were asked to calculate the asset test ratio, there would have been a question mark here. You won't get 0.5. So somewhere in the exam paper you would calculate asset test ratio. And the advice I was talking about is to go to this column next to the question mark, write your answer down here. So wherever you have done some calculation, write the answer down there. The reason I am saying that is because when you need to answer a question, you are commenting on liquidity and you need to quote the figures. You have already written your answer here. You quote your answer, whatever figure you got, you quote that answer. And it's going to save you time. If you did not write it here while you're busy answering this question on liquidity and you want to know what happened, did it increase or decrease, now you're going to go back to your answer book, to the position, the place where you answered asset test ratio, looking for your answer, to come back to write it in there. So quickly sort out your table so you know exactly how the information given to you are presented and what categories of financial indicators they are actually testing. And then when you look at the questions, again use your highlighters and highlight the keywords there to help you to know exactly, and this saves a lot of time. Let me just go over them very quickly. Number 1, comment on the profitability. Remember again what I said, it's not going to be like this in red and highlighted and bold for you. You're just going to see a mess of writing and it's going to look a bit too much. But once you've taken your highlighters and you highlighted the keywords, it's going to make life so much easier for you to answer those questions. Coming back to this number 1, comment on the profitability or the operating efficiency of the business. Quote and explain 2 relevant financial indicators or figures. So what they want me to do is talk about profitability. Then I need to go here, I need to comment, and I need to take just 2. They want me to take 2. I am going to take 2 that is going to actually help me to make a meaningful answer. Let's look at it quickly. The gross profit on cost of sales, I might not take this because this is my markup percentage. It's an indicator that I decided. I decided to make it 65 and to increase it by 5%. So I'm not going to say it has increased or decreased. This is caused by me. Then I would choose from the other 3. I can see my gross profit on sales dropped, operating expenses increased, and my operating profit on sales dropped. So I can take any three because they're all talking about the same thing. They're all showing me a decline in profitability. Expenses going up is not controlling expenses well, also have contributed to the decline in profitability. I'm sure you're getting the idea. Look at number 2. Directors feel that the business will experience difficulty in meeting its short-term debts. Short-term debts, straight away, I'm not going to go any further. I know it's liquidity and I need to take 3. I go to this list. I'm going to look at which 3 are going to best to help me to answer about the liquidity. And just looking at some of them, asset test ratio has dropped, current ratio went up, although it improved there. The difference between these two would be my stock. So I know that I'm holding too much stock. Although the current ratio went up, it went up because of stock. My asset test ratio shows that I do not have enough money to pay my current liabilities. My stock turnover rate has dropped. Stock is not moving that fast, but the debtors collection period has dropped. Debtors are paying quicker. This is a good one compared to the rest. So maybe I don't use this when I'm answering the question. I use the other 3 for liquidity. Right. Although shareholders are satisfied with the percentage returns, they are concerned about the change in the dividend payout rate. So here I have a question on the dividend payout rate, and I also have a question on 2 bullets. The first one wants me why are they satisfied with the returns, and the other one, reasons for the change in the dividend payout rate. So there I need to go to my return ratios, and that would take me to these ones here. My return on shareholders' equity dropped. It was 14. It's now 10. Maybe I don't know whether I'm going to be satisfied. I need to look at alternative investments, look at fixed deposit to see what is fixed deposit. I will be dissatisfied that it decreased, but is this 10 better than an alternative investment? I need to consider that. That be my answer. Looking at the dividend payout rate, there I would first of all look at 44 over 54, 81% of the EPS. 81% of the EPS. Yeah, 44 divided by 54, that 81% was given out. And then the following year, only 22 cents, less than 50% was given out. So clearly there was a big change in the dividend payout. It was 81% last year, and now 49%. The difference that they do not give out as dividends is the portion that is retained by the business. So here the business did not retain much, but in the current financial year they retained 51%. And then there would be many reasons, possible reasons as to why the directors have decided to retain. Maybe they want to grow the company, maybe they need to assess and try and look at improving profitability. So there'll be various reasons that you will come up. Remember, in an exam paper, the reasons that you put there are the possible reasons that you have come up in your mind, and they are not exactly given in the question paper for you to extract those answers. Right, number 4, the directors took a decision to increase the loan. So I told you, when you see the word loan, you don't need to think any further. You go straight to the risk and gearing, and you're going to compare these 3 financial indicators that are given to you. You can see the debt equity, it was 0, and the interest rate, the interest that we are paying, which is 13%. So this is an example of negative gearing, but we moved from a situation where we are experiencing positive gearing, and now by increasing the loan, it did not help the business because we did not use it effectively to increase profitability. And you can see it shows in the other financial indicators as well. Right, the last question, the company paid 4 Rand per share to repurchase 50,000 shares during April. This was 1 Rand 25 above the average share price. Explain whether the shareholder received a fair price for his shares. Right, so we paid 4 Rand per share. We gave him 1 Rand 25 above the average share price. So we need to look at the net asset value. It was 3 Rand 76 and it's going down. The net asset value is the value of the share according to the balance sheet. It's going down 322, and when I look at the market price, It was high and it's also going down, 331. So looking at the trend of where the share price is dropping, um, it could be argued that I've given him a fair price of 4 rand. Another learner might argue that we gave him too much. The share prices are dropping. We should have given him market-related prices. So in this situation, we could have compromised the company by paying too much to the shareholder, by giving him far more than what he deserved for that. So when answering this question, explain whether the shareholder received a fair price. uh, the shareholder himself might consider it a fair price. He got lucky, but then another learner might say, we have compromised the company. We have paid out too much money for the shares that we bought back. So clearly, looking at the way the questions are structured, there's many clues as to which category of financial indicators you would use, and they also are very specific as to the number of financial indicators that you must quote, and you must also show the trend. Remember, you must show the trend, and in some cases you do a calculation, like in number 3, where I've got the dividend payout policy. I want you to comment on that. It's not given on the list. I need to do a calculation to get that one. Okay, so this is just an example. You need to practice many like this, and just stick to the strategy, stick to your understanding of what each category is telling you, and then you cannot go wrong. Interpretation, that is not using financial indicators. The common questions that come out in exam, in the past few exam papers, they talk about the majority shareholding. When you see a question on majority shareholding, let's quickly look at an example here. We have a company, Corona Limited. It has an issued share capital of 700,000 ordinary shares. This is the issued share capital. So I'll give you 3 scenarios. Mkhize owns 340,000 shares in this company. The business will not be issuing any additional shares, but Mkhize wants to be the majority shareholders. So now, if you look at his shareholding in the company, how many shares must he buy? The first thing I need to do is look at what is 50% of the shares. To be a majority shareholder, you must own more than 50% of the shares in this company. So if he was owning 350,000 shares, he would be owning 50%, and therefore he would be a majority shareholder. But he doesn't have that. He has 340,000 shares. So he's got a few choices. He can buy 10,001 shares. That will take him just over 50% of the shares. He can't have 350,000. That will be equal to 50% of the shares. Or, because shares are not going to be sold in units of 1, he needs to buy 350,100 shares. 350,100 shares is what he needs to have, so he needs an extra 10,100 shares. So these are the possible answers. The third option that is also accepted in exam papers is to find 51%. What's 51% of 700,000? It's 357,000. He's got 340, so he needs an extra 17,000. So in order for him to be a majority shareholder, he needs to buy this number of shares. Now you might be wondering, the business will not be issuing any additional shares, so he can buy these shares at the stock exchange. Remember, the stock exchange is where shares are bought and sold. He buys it from other people who have shares in the company and they don't want to be shareholders anymore, and that's how he can increase the number of shares that he owns in this company. That will make him a majority shareholder. By extending this scenario, he buys an additional 20,000 shares. We said, okay, he needed 10 more, but he bought 20,000, so he feels good. He's now a majority shareholder. During the December holidays, the business issued a further 100,000 shares. He was not around, and he was not able to purchase any of those. From that 100,000, he was not able to buy any more. How did this affect his percentage shareholding? So in this scenario, you need to look at what happened to the shares. Right? You'll see that 700,000 is now gone up to, he was, with that 20,000 extra that he bought, he had 340, he bought 20, he's got 360,000. He was 51.4%, he was smiling, he was the majority shareholder. But now the company issued an additional 100,000 shares, he still has 360,000, So he's gone down to 45%. So he's no longer the majority shareholder in the company. So that's where that question would stop. Because how did it affect his shareholding? His shareholding dropped to 45% and he's no longer the majority shareholder in that company. So he didn't like the situation. He convinced the CEO to repurchase 85,000 shares from his old friend. One of his old friends don't want to be a shareholder anymore. He told the CEO, buy back those shares. And why did he do this? Obviously, if the company buy back the shares, it's going to reduce this 800,000 shares. So the company would not have 800,000 shares anymore. The company's share capital is going to be 715,000 shares. That is 800 minus 85,000. We bought back the shares, the share capital dropped. Okay, so now his 360,000 shares divided by the new number of shares makes him 50.3% of the shares. So now he did not buy any shares, but the company reduced the share capital. So just by that action, he now is back to being a majority shareholder. 50.3% of the shares is only more than 50% of the shares. He's once again smiling. He is the majority shareholder. Why did he do this? He wants to be a majority shareholder because there are many advantages to being a majority shareholder. He's going to influence major decisions in the firm. There is an element of control. He can appoint directors, he can appoint auditors, and anything that goes to a vote in any of the board meetings or shareholders meeting. Obviously, being the majority shareholder, what he says will go. Okay. Another example of not using financial indicators, you get questions based on community social responsibility. Now, simply what does that mean? Uh, According to the King Commission, a company has to focus on the community as well. They need to give back to the community. They need to look at other factors besides just profitability. So I've got an example here. The business has invested 200,000 in staff training and donated computers valued at 150,000 to local school. The question would ask you, why did they do this, right? So here are some possible answers. Giving back to the community that supports the business. The King Code emphasizes the triple bottom line, corporate governance. The King Code is emphasizing that the company must not only pay attention to profitability, they must also pay attention to the environment and to the community that supports that business. Improvements in the image of the business. Spin-offs include better publicity, extended target markets, tax benefits. So there's various reasons why a company would do that, and you need to structure your answer in short, clear points so that it's easy for those people who are marking them. They will not be confused when you say, you don't need to say social, community, social responsibility. You can explain it in any of these ways. And lastly, looking at ethics and conflict of interest, other scenarios. I'll just list some scenarios for you here. The CEO wants to record his personal holiday expenses as a marketing expense of the business. Obviously, he wants to do something wrong. He went for scenarios would include the external auditor as shares in the company, or is married to the CFO. Okay, so the chief financial officer is married, so he has a vested interest. He's an external auditor, so obviously, if he has shares in the company or he has a vested interest in the company, he will not be able to give an unbiased opinion. So there we've got a conflict of interest coming in. The third factor, a director has convinced his friends to sell the shares as fast as possible, as he obtained confidential information that his section of the company would be closing down. So in accounting terms, we refer to this as insider information. He's got some information that the general public does not have. He's using his influence to make some decisions, and that is also an ethical issue there. The next bullet, the marketing manager employed his nephew to control the advertising budget. So here we have a case of bringing in family members to work in your business. The term that we use here is nepotism. If you come across that, again, it's a conflict of interest. It's also on the border of ethics. So you can get a scenario of like this here. You need to comment on that one. And the last one, the purchasing manager accepted a commission. When you see inverted commas commission, that means it's not a real commission from a rival firm to purchase their excess stock, which they are not able to sell. So clearly something underhanded is going on here. Your purchasing manager is taking a commission, if it's in inverted commas, this here is referring to a bribe. Some corruption is taking place. He's taking money from a rival firm so that he's putting his firm into a position where they are buying the excess stock of that company. Obviously, this company would not be able to sell that stock. So, as you can see, these are some of the scenarios I picked up from different papers over the years. And as exam papers become more predictable, examiners are trying to come up with more and more scenarios just to see if you are able to identify the ethical issues involved or a conflict of interest or something underhanded is going on and they expected you to comment on those things. So good luck with this topic. Practice many examples. Look at many past exam papers. More importantly, look at different marking guidelines to see exactly how they structure the answers. Focus on the vocabulary, the words, learn those words. We do understand that a lot of children have a problem with expressing themselves clearly because most of the time papers are in English or in Afrikaans, and try to be simple, try to be to the point. Sometimes it is even useful